Okay, so Chapter 11 is talking about incremental cash flows, particularly involved in making new investments or mergers or acquisitions. And anytime you need to evaluate a purchase of an asset, you should look at the cash flow objectives, and you want to think the difference between the incremental cash flow versus the sunk costs. The incremental cash flows is what we want to measure and look at. The additional cash flows created by the purchase of something. For example, you may purchase a more fuel-efficient car. So to figure out how much you're saving, you'd want to look at how much were you paying for gas originally, say $50 a week, and now you're paying $30 a week, so $20 would be your incremental cash flow. So even though your savings cash is also incremental cash flow, something you invest in saves you money. And so that's part of identifying the types of incremental cash flows. So savings can be an incremental cash flow, like the Zoom simulation when you make those operational investments and you save on the production of your car $300 per level the next year, up to $12,000. Those are considered incremental cash flows because you're saving. And we'll talk about why financing cash flows are not included in the analysis. We don't look at the cost of the capital of these when we calculate the cash flow. Okay, so incremental cash flow occurs if you accept the investment in your capital budget, include it in your capital budget, and you're looking at what additional costs, additional cash you're going to generate or save by this investment. So you may invest in a machine that replaces human beings. So you have a machine to fold boxes to fold and package boxes rather than someone sitting there folding a box, putting something in it and packaging it. Or you may decide to go from a manual process to a factory machine to make whatever product you're selling. Or you could just be buying another investment, buying another business or expanding. So all these things can be considered incremental as long as you look at the true growth of the cash flow, adjusting for any change in your original business. So one example I used last class is if you're going to build a second franchise and you build it too close to your original franchise, how many of your original customers are going to go over and go to the new location? It could be quite a bit. All right. We'll talk more about that. And we always want to take the cash flows with the project minus cash flows without the project. Okay. So the initial cash investment in cash flow is going to be the purchase price of the asset, which could include the installation and delivery costs. And any additional investment you may need, basically looking at the working capital tied to the project. So if you open up another location for your business, and you need, say you have one laundromat in the town you live in, and you open up a second laundromat in that town, you want to look at the additional investment you'll have to make in quarters, because you'll have to stock the laundromat with quarters and cash and maybe some supplies. So that would be considered net working capital. So you would have to, the purchase price of the business, say you're buying a location, and then the installation delivery maybe of the laundry, washer, and dryers, and then the working capital, the cash you may need, and the inventory you may need to get started. So all that is included in the investment, which is year zero of the cash flow. So that's always a negative. And then the operating cash flows are going to include the revenues minus the costs and expenses and taxes. And you want to look at, when we talk about things like opportunity costs or externalities, we're talking about, what are we giving up by having this particular investment versus a different investment. So maybe if you had a choice to go, say you were accepted at both Harvard University and Stony Brook University, and you chose to go to Stony Brook over Harvard, is there an opportunity cost there? You would have to look at what's the additional cost to go to Harvard versus a public school. So there's a savings there. But then you have to look at, well, how much more additional starting salary will I get if I have a degree from Harvard versus Stony Brook, if you could measure that in dollars over a lifetime. And then that would be your opportunity cost. So, so that's something to look at and think about. Businesses have the same choices. Okay. And then the shutdown costs, the cost of shutting the business down. Some businesses may be for a finite set of time. Maybe you're coming to Stony Brook from another state or another country, and while you're here, you're going to run your pretzel cart on campus. But you're only going to run it for 4 years, and once you graduate, you're going to sell it to somebody else. And a pretzel cart on campus would make a ton of money, because students love pretzels, and they're fast, easy, and cheap to make. And they could do a tremendous amount of money. All right. And then, so when you're shutting it down, if you're either selling the business to somebody or just getting the salvage value of the business, those are things that you want to add as additional cash flow. Okay, so we want to measure the cash flows and the change if the project is undertaken. And that's pretty simple. We don't want to include any sunk costs. A sunk cost is money already spent. So if you spent money to do a marketing analysis of an area, and you want to look at, I want to put a business in this town, let's do a marketing analysis and figure out what business would make the most money here. And then you discover that this town has no pizza restaurant. So that would be, it has 16 Chinese food restaurants, but no pizza restaurants. So you figure out that would be a better business to install. Now the money you spent on that initial marketing demographic survey is a sunk cost. You spent that whether or not you're going to open a business, and that may have determined not to open a business. But either way, that's a sunk cost, and you wouldn't want to attach it to the performance of the project. Same thing if you already own a piece of land and you've been in your family for 50 years and you own a piece of land and you decide to put a business on that land, or you decide to build houses and sell houses from that land, or rent it out as a farm, anything you decide to do with it, you can't include the cost of the land as part of the project because that's a sunk cost. The land has already been purchased, and it wasn't purchased specifically for any project. It's just been purchased and paid for a long time ago. You don't include that in the cost of the project when you're evaluating, because you already have that land. No matter if you take the project on or you don't, you still have the cost of that land, so it's irrelevant to the analysis. And overhead is a concept. We wouldn't want to include. We don't want to include an allocation of existing overhead. And what overhead is, it's sort of the cost of your business already. So if you have a business and you have accountants and lawyers and salespeople and marketing people and operational and maintenance people, these are all. And then you have health insurance and life insurance and all those sorts of benefits you give your employees, and you pay taxes on your property. These are all overheads that exist already. And starting a new business or not starting a business or expanding your factory, you don't want to allocate these existing overheads because they already are there. You're paying them anyway. They have no influence on whether or not you do the project. Now, if the project develops new overheads or additional overheads, you could look at those. But you don't want to look at the existing overhead. And of course, you want to subtract any loss of sales of other products that may happen if you take on this new business. So, like I was saying, if you have, if you are deciding to, in that very basic concept before, open up a second location, and you lose some of your customers to the second location, you'd want to subtract those sales from the sales of the second location. So the second location generates $500,000 of sales, but you're losing $100,000 of sales from your first location. You don't want to count those because those are sales you would have had without anyway. And that's a real, that could be a real worry in some businesses, especially franchises, and especially when you're stealing sales from somebody else's franchise. They're going to be a little bit more defensive. So if, I've seen you may have seen this in different places where two 7-Elevens are very close together, or two Dunkin' Donuts seem very close together, or two Starbucks, or two did I say Subway already? Two Subway sandwich shops may be very close together, and you wonder why is that? Okay. And then include any cost savings from the cash flow from the product. So in the Zoom simulation, when you bought those operational investments, you got $300 savings on the manufacturing of the car the next year for every level. And some companies that perform very well, they wound up, having $10,000 to $12,000 of savings per car, and that's how they're able to generate 80% and higher gross profit margins. Okay. Okay, so let's put a timeline up here, and here's a timeline. So in year 0, that's when the business is born, is your initial investment. And starting a business is expensive. It costs a lot of money, and you're taking on a lot of risk to start a business. So you could, 100, 200,000 isn't really that unusual for starting a small business. Some businesses are less costly and more easily to set up. Like you could set up, a hair salon pretty inexpensively, or maybe an ice cream store. But then if you want to set up a laundromat, that's going to be a lot more money, because those industrial washers and dryers are not the same cost. You can get a washer at your home for $500, but if you want an industrial one, it's like $3,000. So there are a lot of costs in setting up any type of new business or expanding an existing business, and then hiring employees, and a lot of money has to be put up front before you start making any money. And then when you start a new business, it takes time to develop clientele and for people to come to the business and come back and until it gets to a point where it's really profitable. And that's why you'll see when new businesses open up, they're so nice and friendly to you and so appreciative of your business. And then after a while, the business is doing well, and then they start hiring, the owners work there less and less, and they hire, people to manage the store. And then suddenly you're just, a piece of trash coming in that they don't have 2 seconds for, or get frustrated if you ask a question. Ever felt like that way? You're at a business and you felt like the people working there you're a burden on them or a bother? Yeah, that's a business where they lost touch with why they're in business. And they've most likely hired somebody else to run the business or work there, and they just it wasn't impressed upon them how important it is to maintain and keep a customer. Well, that's why successful, very large businesses like department stores and different things, they focus on retaining customers and training employees on customer service. So that way, if you want to return something, they don't give you an attitude about it. They're just, if you have your receipt and everything, it's no big deal. Okay, return it. But some small businesses, if you want to return something, you have a problem with a service or a product, they could really hassle you because they're not so enlightened about customer service. Like, the big, most successful companies generally have the most generous return policies and customer, avenues for customers to complain. Because the bottom line is you want to keep that customer happy. Because if you maybe as a small business owner, you'll save a few dollars by not accepting a return or by not, replacing a meal if they're unhappy with something you serve them. But in the long run, they may not come back, and that could be 20 to 50 additional visits from this person you're not getting the profits from. So was it really worth it to fight over that, whatever the product was? Okay, so operating cash flows every year moving on, and N just signifies N amount of years, so that could be any operation period. And then the shutdown costs, when the business is ready to end, which you could do two things. You could sell it to somebody else, or you could just close the business down and sell the assets. So we're going to be doing an example before this class ends of looking at a business of purchasing the remaining 34 locations of Record World, which you don't know about anymore because it went out of business, but there's a few years left of life at this company before they went out of business. Because when you selling records and albums and DVDs, in a technological environment where everything's going digital or downloaded or streamed, isn't a really great business model. I'm still not sure why FYI is existing in the mall. Is that FY, is that what it is? FYE, whatever that stands for. Yeah, thinking of an acronym, but that can't be right. But anyway, maybe it's all those stand-ups they sell. You know, did you get your stand-up of whatever? Justin Bieber stand-up? All right. Okay, so here's an example. Let's look at this company. They're going to replace an old production machine with a new one. And this is something that, could be something that happens in your life. Maybe you're going to replace old furnace with a newer, more efficient furnace, or an older, bigger car with a more efficient car. Like you're going to trade it in Yukon for Prius, and you want to know what the gas savings is. You want to, maybe you're going to replace your windows in your house. Or I remember the day I replaced all my light bulbs with those high energy, not high energy, highly efficient light bulbs. And my electric went down tremendously. I was surprised how much money I was burning in just having those regular light bulbs. But they were expensive to purchase, but then the money you save, like I have this one LED bulb on the, say on the driveway that I have on all the time. And I calculated that the cost of running a regular overhead outside was about $35 a year, and this new LED bulb was $4 a year. But I had to pay $25 for the bulb versus like $5 for the other one. So companies, you know, they look at this closely. If they're going to buy a new machine that's more efficient, maybe you're a company, maybe a pizza store, and instead of having a conventional gas-fired oven, you buy one of these new solar-fired ovens. It uses solar power somehow. Maybe the solar power generates electricity, and then the electricity operates the oven. If you want something that would make sense. Then installation cost and delivery, you could add to the cost of getting the new machine. And then any additional networking capital it may require. Training costs to operate it. And for a lot of machines, even simple machines, it does pay to train the employees because they think they know how to run it, but if you don't run it properly, you could really damage it. Just like a car. If you don't run a car and do proper maintenance and you change the oil, you could really damage it and waste a lot of money. Salvage of the old machine, selling the old machine, we could deduct as a savings. And then the book value of the old machine, that comes into play with the tax rates. If the book value is 0, then any money we sell the old machine for, we have to pay taxes on. Because we told the IRS it was worthless, and we took a tax deduction and deducted it down to 0. So if we sell it for anything, we are responsible for paying taxes on the remainder. Okay, so if we add up, so the training is actually tax deductible. So we're just going to put the amount that we pay after tax because it's tax deductible. And then we could look at the salvage value. So if we sell the old machine for $10,000 and our tax rate is 40%, we're paying 40% of that to the government as a tax because we took credits for it too early. So then we could see that if we have the cost of the machine, $55,000, and then less the sale after we pay our taxes, we're going to get a $6,000 amount of revenue from selling it. So the true cost, the initial outlay of the asset, this machine is $49,400. And you know, this is a common analysis for a lot of manufacturers who are constantly trying to make their factory more efficient and more cost effective. And one way to do that is generally to switch from human labor to more machine labor. And that's why you remember you must have seen those classic films or photographs of the robotics in auto factories, how the arms come out and they put all the rivets in, you see all these sparks flying, and that saves, it costs a lot of money to install those robotics, but over time it saves a great deal of money and you get usually higher precision and quality than if it's, just having human workers. Okay, so by installing this new machine, we have an expected increase in revenues of $5,000 per year and a decrease in cost. So maybe this new machine, that solar pizza oven, it's bigger so we could make more pizza. And then we also figured that, you know, we can advertise buy our pizza because it's carbon negative, and you'll be helping save the planet for every slice you eat. And there'll be a bunch of fools who'll be like, this is great, I'm going to go save the planet. I don't care how awful that pizza is. At least I don't have to feel guilty while eating it because I know I'm not increasing the carbon footprint. Decrease in cost because we don't have to pay as much power for it. The projected life will say it's going to live 4 years, and then we could sell it at that point, and we'll assume that this, you know, our depreciation schedule is going to come into play because we can depreciate the asset, and that's watching this. Okay, so the that's something you can tell me too when you see that up there. But okay, so we know that if we have a new project, there's a we have to use the modified accelerated cost recovery system that we learned earlier in this class for depreciation. So anytime we buy an asset, we're going to depreciate it as part of the cash flow. So we're going to go in and we're going to depreciate the asset according to IRS regulations using this accelerated schedule, because the amount of money that we can depreciate equals a tax savings. Were you up late watching Game of Thrones? No? Okay. Because you nodded out a bit. Yeah. Oh, it doesn't bother me. So we know about this table and we can use this. Here's the table. This is for a 3-year asset. Remember, the first and last year are half year, 6 months. So for any length of time, 3 years, 5 years, you have to add an extra period onto that, and we've covered that in previous classes. So if we have an asset that we're gonna purchase and after shipping and delivery, and it becomes a $50,000 investment. If we're gonna, just as a refresher, if we're gonna do depreciation, we're going to have to depreciate the asset for 4 periods for a 3-year depreciation, and those 4 figures will add up to 50,000. So if you add up, we're breaking this percentage here equals 100%, and this amount of depreciation is the full 50,000, and we deduct that. And the reason we do that is because we can deduct it from our taxes, lower our income, lower our taxes. So it actually helps to increase the cash flow because we're paying less tax. Okay, so here's a cash flow project, and we have an increase in revenue up here, and then we have our increase in revenue up here, and we have our decrease in costs. So, and then we have our depreciation. So the change in income actually shows negative for the first 2 years because the depreciation is larger than the revenue and decrease in costs. However, when we're calculating our after-tax value, this loss in income actually gives us a tax credit. So because we took the depreciation, instead of paying taxes on $13,000, we're receiving a credit on $3,500. The same thing in year 2. We could have paid taxes of again $13,000 worth of taxes, but instead, because we depreciated, we're taking a $3,800 tax credit. And then in the last 2 years, where our income is shrinking because of the depreciation, so we're paying less tax. Now, when we're calculating cash flow, however, we're going to add that depreciation back in to calculate the real cash flow at the bottom, because depreciation is a non-cash charge. It's an imaginary number we're sticking in there so we could pay less tax. But if we want to look at our pockets and see how much cash we really have, that would be $14,400, because this $16,000 isn't really being paid to anybody. We're just putting it in as an accounting IRS footnote to lower our income, to lower our taxes, in this case getting a tax gain. So then if we look at our income after tax, we want to add our income after tax plus our depreciation, add that back in, the same number, and then we get our net operating cash flow, which is the real money that we'll see in our pockets. So the IRS thinks we have a loss, but we're sitting there with this big pile of money. That's our cash flow because of depreciation. And that's why, since we're allowed to do that by the IRS, why not? So we do it, and we get a more cash. Just like tax season is over, and some of you may have filed taxes if you're not a dependent or someone's not claiming you as a dependent, or even, and if you do file taxes as an independent and you take your deductions for college, you might have noticed a nice check coming your way for your taxes. And that's, but imagine if you were going to get all the money that you paid in taxes at your job back. That could be a lot of money. So if you could show enough itemized deductions, interest on your house, taxes, real estate taxes, tuition paid, you could get just about all that money back if you had enough legitimate deductions. So that's why you file taxes, for the hope of getting some money back. And they actually, taxes recently for college students are pretty nice. They have some nice tax credits, and they have some nice, if you're undergraduate, to give you some money back. So some of you, if you're not being declared as a dependent, if you are being declared as a dependent, then your parents get it. But you could not have, I think the way it works in one of them is you could not have a job and not have any income, and they still give you $900 back if you're going to school. So if you didn't file taxes because you thought you had no income or no job for the year, you probably should have filed taxes, because there's a way of getting money just for going to school. So something I probably should have told you before the tax season ended, but okay. So positive, negative effects on the existing projects, externalities. This is looking at, this word extras in there, and it's looking at, other effects of doing this. So positive, negative effects on your existing project. So if taking on this new project, what are the positive and negative effects? So you may say in your mind, you decide that you want to accelerate your undergraduate time by taking 7 courses instead of 5. Full-time is 4 courses, right? So let's say with 4 courses. You can take as little as 4 courses to be full-time, have a dorm room, and get financial aid, and be a full-time student. But, so I think most of you agree if you took only 4 courses, you could probably do very well in those 4 courses. So if you were to take 7, up to 21 credits, which some students are doing. Is anybody doing 7 classes? Okay, 1 student. A couple other students who are afraid to raise their hand because they don't want to seem too nerdy. But you should be proud. 7 classes is a quite an accomplishment if you do 7 classes and pass all 7 classes. But you have to realize you've probably given up the ability to work part-time. The ability to, there's some things you're giving up to do 3 additional courses. But you're also gaining, because now if you graduate a semester early, because you take 2 or 3 courses more every semester. I think if you take 5 to graduate on time. So if you take 7, maybe graduate a semester early, and that would save you X amount of dollars for that full semester. So these are all things you should be thinking about. So if you're a business, you want to think about, some of the positive, negative effects of putting on this project. So if you're a restaurant and you open up multiple locations, a positive effect could be that now you have more of a presence, advertising will be more efficient, you could share resources among the restaurants, but negative, you may be losing customers at certain restaurants because they're going to your other location. And this could be part of the incremental cash flow analysis, and it's often difficult to estimate what's the effect? Okay. So real options is looking at opportunities that may exist from a project. So in the real options, we may want to adjust or tweak or revise a project based on, some additional factors. So these options could, affect the value of the project. And it's just looking at things, at different percentages, which I'll show you in a second. Okay. So you may want to revise the project. based on some of these real options. And I think they have, here's a slide on it. This is a better way of explaining it. Okay, so you could look at, if I make the investment in this business, there's three things that could happen. The business could be, you know, I could invest in the business could be not so successful, successful, or very successful. You know, and then there could be other options like the economy. If the 40% chance the economy won't be that strong, which is going to affect my real cash flow, 20% the chance the economy will be okay, and a 40% chance the economy will be do very well. So these real options are just saying, you know, let's layer over our investment some possibilities. What are the chances that the business will be very successful or not successful? And then what are the chances the economy will be very accommodating or not accommodating? So if we overlay some real options, we get multiple scenarios of what our business can do. So that way, if you're going to really want to analyze it thoroughly, you want to say, okay, give me the best case scenario and the worst case scenario and the most likely case scenario in between. So they give you three scenarios. Here's most likely what will happen if you invest in this business. But here is two possibilities as far as the top end. This is the best, you know, we think you could do if everything goes right, and here's the worst. And then that way you can kind of get an idea. All right, even in the worst case scenario, I'm still making money, so the risks are less. So some of the riskier businesses, though, may be where there's a chance to make some money, but there's also a chance to lose a lot of money. So if the chance of making a lot of money would have to be strong enough to outweigh the chance of losing money. So it could be a riskier project, but if it works, you can make a tremendous amount of money. If it doesn't work, it could lose a lot of money. Okay, and of course, we use net present value to estimate the required rate of return on these projects. And what, you know, we also have interlaced on the cash flows, the probabilities, and then the net present cash flow, and we sort of multiply the cash flow by the probability, and we can get sort of a real option net present value. Okay, so let's talk about shutdown costs. We want to shut the business down. So, like I said, that pretzel cart on campus, and you're graduating, you don't need it anymore, you're going on to a better full-time job, and you're going to shut down this business. And that has tax consequences. So the sale price minus the basis to set it up. So if you were to establish this pretzel cart originally, and you got the proper permits and the student association, you agree and everything, you can have this on campus, and you wound up making, say, $500 a day on this cart, and you make, you know, it's only open during the week, you make $2,500 for the week. So now you've grown it into a successful business, a proven business. It's worth more. So when you sell it, you'll probably sell it more than it cost you to establish this business. So, and we have to look at any depreciation you may have taken on the basis of your original purchase. So if your pretzel cart's fully depreciated, whatever you sell it for, you're going to have to pay full taxes on that. This is fully taxable. And then you would recover, before you salvage, you shut down a business, you want to recover the net working capital. So that, think of it like this. You're not going to give the pretzel cart to the next owner stocked with inventory and cash. So you're going to open up the cash register, that's your working capital, and you're going to take out the $200 you start every day with to make change. And then you may also take your inventory as well. And you just give them the business and the cart, and that's what you sold them. So the working capital you get back. You may even sell the working capital to him and say, listen, you can get I'll give you a separate price for the inventory, you know. Okay, so here's an example. Sell the asset for $15,000. This tax on that sale is $6,000. So the net sale is $9,000 after you pay your taxes. The return on working capital is $3,000. You don't pay tax on working capital. And then so the total shutdown value is you're getting $12,000 back when you end that business. So that becomes part of your shutdown. So in year 4, you add your shutdown costs to your working capital, and that becomes part of your cash flows. And then, so in evaluating the project, you don't want to include the financing costs of the cash flow, incremental cash flow analysis of the project. So when we do the net present value equation, which we're going to use, remember net present value last chapter where we discounted each of the cash flows and added together and got, either positive, negative number, and that was our net present value. We're doing the same thing with these incremental cash flows. We're going to do a net present value calculation on them, but the financing costs are going to be included in the discount rate. So the K here is going to represent the financing cost. So if we pay interest on the project, and this could be a trick question on the test or in the homework where they may say interest on the project is $5,000 a year, and you need to not include that because you'd be double counting them because we're already escalating we're discounting the cash flows for that interest rate. So when we divide by 1 plus K, we're already discounting the cash flows. We're taking the interest rate out of the cash flows at the end. So we're not going to count any interest paid during the life of the business. Yay, we're done.